to VC or not to VC. So today we'll see what exactly does a VC do, how does VC work, what type of companies are best suited for VC, and what type of companies should not raise VC. So let's answer the first part of the question. To begin with, what does a VC do? I'm going to answer that in a language you all understand, memes. So my friends and sometimes my colleagues as well think I party all day. My mom thinks I'm an accountant. Society thinks I'm some sort of money man. Entrepreneurs think VCs play golf and squash all day. VCs like to think that they add value. But to be honest, the work of a VC is similar to that of a salesperson. They are selling to everyone. Entrepreneurs, limited partners, fellow investors, and more or less every stakeholder involved in the ecosystem. Now let's dispel another myth about VC. What is common among all of the companies which you see here? Iconic companies, some of them. And most of these companies, I'm fairly certain you have used the products and services in some shape or form. They were all VC funded and were successful. Now, have you heard or seen any of the companies on the screen right now? All of them raised more than $100 million in VC, but failed. And the company that you see here, you would have heard of them. They did not raise any external funding, but are actually really successful and bootstrapped. So what is the key takeaway here? Key takeaway is that VC funding does not mean success. And there is more than one way to build a company. So how does venture capital work? There are three main stakeholders. The first one being the limited partner or LPs. The second one being the venture capitalist or the VCs. And finally, the startups. The LPs give money to the VCs, and the VCs in turn invest in the startups. When the startups become big or they reach a certain stage, some of the VCs get an exit, either in the form of a secondary sale where they sell their shares to some other third party, or via a merger or acquisition, or when the company goes IPO. From the returns, the VCs then give back the initial invested amount plus the profits back to the LPs. But before that, they deduct a certain portion of the profits which they keep for themselves called the carry. Now, who are the limited partners? There are education institutions such as Harvard, MIT, and Yale, pension funds like the Government Pension Fund of Japan, sovereign funds such as the Norwegian or the Singapore Sovereign Fund, insurance companies, and family offices. Examples of VCs include Kalari, Sequoia, Axel, and Tiger Global. And companies or startups are ones like Dream11, Paytm, Unacademy, and Cred. So what does success mean for a VC fund? In one simple word, it's returns. It's relative, but generally a 3 to 5x return on overall capital in 10 years is considered the norm. Now let's take a hypothetical VC fund. We are at VIT, so let's take the VIT venture fund. I'm simplifying it, but basically it would be a $100 million fund. It has a 10-year life, 20 companies, and $5 million a company. Right? That means you're investing $5 million in each company. And you're promising a return of 3 to 5x to your LPs. That is a $300 to $500 million return. Now before that, an analogy. Let's say VC is akin to rocket fuel, which you invest in companies to get to your overall goal of 300 to 500 million in 10 years. Another way to think of it, if VC is the rocket fuel and your destination, the end destination is Mars, which here is about 300 to 500 million dollars in 10 years. You need a mode of transport to get there. And the mode of transport here is companies. Here, The companies essentially could be rockets, could be aeroplanes, cars, and bicycles. Theoretically, you can use any of these modes of transport to reach Mars. The only difference is the time taken. Now, please note that none of these are commonly used terminologies for companies, and I'm just using them just to make sure I'm able to simplify it for you. Now, you make 20 investments in the first 3 years. Most of the initial investments of any fund are done in the initial first 3 years so that it gives them time to mature. The expectation is that all 20 investments will be rockets, which means that these companies are expected to grow really big, really fast. But remember, 90% of all companies fail within the first 5 years of founding. Not just VC-backed companies, any company in general. So in reality, right, only about 5 companies, or rather 5 companies will fail or expect to fail within the first few years of your funding. And you will be left with about 15 companies. Now years 5 to 8 are where companies start to break out and show traction. Some grow really big, really fast and become like rockets. Some grow a little bit more slower. And some are yet to show their colors. And eventually at the end of year 10, you're probably left with something like this. 2 rockets, 1 car, about 5 bicycles. Now what do each of these mean? Now you invested $5 million in each of them and say that the rockets returned back $200 million each. One company returned $25 million, which is the car, and about 5 companies returned back to capital, which is $5 million each. Right? So the overall return or the profit is $450 million or 4.5x of the fund. Pretty good. But one thing you see here, about 90% of the returns of 400 million was given only by 2 companies. Remember, you invested in 25 companies. Only 2 companies gave you almost all of the returns. Now, you would have seen this in other areas of your life. They call it the Pareto Principle or the 80-20 rule. And we see it's known as the power law. The power law is the OG law for venture capital funds worldwide. Okay? Mark Anderson of A16Z points out, right, a very, very famous venture fund. Each year, 4,000 tech startups seek VC funding. Only 200 are seriously fundable, and probably 15 of those give all economic returns. Put it another way, extreme version of this, 97% of all exit profits come from less than 10 companies of the 10,000 startups which seek funding each year. So what do VCs look for when investing in startups? VCs look for rockets, companies that can grow really big, really fast. So what are the characteristics of such rockets? Number 1, large markets. You cannot become a big company in a small market. Number 2, complementary teams. For every Gautam Gambhir, there's a Zahir Khan. For every Virat Kohli, there's an R. Ashwin. And at the helm, there's an MS Dhoni who's leading the pack. Now, all of them come together to create a cohesive unit which can execute. And finally, competitive differentiation. The product or service that you are offering as a company should either be the fastest, the cheapest, or the best. Technology companies tick off all of the criteria. And why are tech-first companies suited for VC? One simple rule. The marginal cost of production or distribution is either zero or very minimal. This allows technology companies to scale very fast and grow really big in a short period of time. So how does it look like when VC works out? Let's take the example of a fund called Benchmark in the US. The first fund of Benchmark was an $85 million fund which they raised from LPs, and they invested into eBay about $6.7 million. And when they exited with a profit of $4.2 billion. And overall, that fund returned $7.8 billion to the LPs, a return of 92x. Remember, the VIT fund returned 4.5x. And we said that probably a 3 to 5x return over 10 years is good enough. So what does VC success look like? Pidilite, a very successful company, which recently reached a market cap of 1 lakh crores, took about 67 years to reach a revenue milestone of $1 billion. Now contrast that to another VC funded company called Stripe. Stripe took 7 years to reach the same milestone. Of course, there is some amount of selection bias here, But the aim I'm trying to get to here is that when VC funded companies work, they reach milestones in record time, something which has never been seen before. Now let's look at VC funding in India. Approximately $200 to $250 billion has been invested in Indian VC till date, and you can split that into phases. The slow growth phase till 2007. Flipkart was founded in 2007. InMobi becomes India's first unicorn in 2011, and Flipkart is valued at $100 million the same year. Flipkart becomes a unicorn around 2012-2013, and after that, VC takes off. Jio was launched in 2016, and that opened the floodgates for investments in India. There was a slight dip during COVID, but overall, we expect to see about $25 to about $35 billion going to Indian startups each year, and that's only growing. Flipkart was the biggest exit in the Indian startup ecosystem till date and showed the promise of what Indian startups could deliver. And that paved the way for all the unicorns which you see here. It is important to note that this is not an exhaustive list, and unicorns are being created every week. VC funding picked up in India due to two main reasons: digital penetration and a relatively young population. We have the second largest digital population in the world after China, and approximately 54% of our population is between 20 and 40. VCs miss investing in companies as well. Dream11 got 150 rejections before their first round of funding. There was a VC who passed on investing on Flipkart because the founders were chappals to the meeting. And even a VC passed on Google because Larry Page, the founder, was apparently arrogant in the meeting. Raising venture capital is not meant for every business. Some businesses inherently have a slower growth rate. Some require lesser capital. And some do not have the technological leverage to grow really big, really fast. So essentially, VC is meant for businesses which literally go big or go really big or go home. And the companies here went big, and one could argue that they had a cultural effect on how humans work or interact. So the best VC funded companies succeed in changing human behavior on some level, most times for good, sometimes not so good. But as with everything, there are exceptions to the rule. Thank you.